Have you ever wondered how a bank that survived 2 world wars, the Great Depression, and nearly 170 years of history could collapse in just a few days? This wasn't a small local bank. This was Credit Suisse. It's one of the most respected financial institutions in the world. Governments trusted it. Billionaires trusted it. Some of the world's largest companies trusted it. For generations, the name Credit Suisse represented safety. But in March 2023, that trust disappeared almost overnight. Customers rushed to withdraw their money. Investors lost confidence. Its share price crashed. And a bank that had stood since 1856 had to be rescued by its biggest rival. What happened? How does a bank with nearly 167 years of history fall so quickly? The answer wasn't one bad day. It wasn't one bad investment. It wasn't one bad CEO. It was the result of years of boardroom decisions that slowly destroyed trust. To understand how everything fell apart, we have to go back to the beginning. Credit Suisse was founded in 1856 by Swiss businessman Alfred Escher. At the time, Switzerland was growing quickly. The country needed railways, factories, modern businesses, and all of them needed money. Credit Suisse was created to provide that money. Over the decades, it helped finance railroads, industries, and businesses across Switzerland. As the country became wealthier, so did the bank. Eventually, Credit Suisse expanded far beyond Switzerland, opened offices across Europe, America, Asia, and the Middle East. By the early 2000s, it had become one of the world's largest investment banks, managing hundreds of billions of dollars. For millions of people, Credit Suisse wasn't just another bank. It was one of the safest places in the world to keep money. But success created a new challenge. As competition between global banks became more intense, simply being safe was no longer enough. Banks wanted faster growth, higher profits, bigger bonuses, and larger market share. Investment banking became one of the fastest ways to make enormous amounts of money. Instead of steady profits, banks began taking bigger risks. Credit Suisse joined that race. For years, the strategy appeared to work. Revenue increased, the bank expanded. But underneath those impressive numbers, small cracks had already started to appear. Most people couldn't see them. Investors ignored them. And inside the boardroom, the warnings were becoming harder to ignore. By the early 2000s, Credit Suisse had become one of the biggest banks in the world. It wasn't just lending money anymore. It was competing with Wall Street's biggest names. Banks like Goldman Sachs, Morgan Stanley, and JP Morgan were making huge profits through investment banking. Credit Suisse wanted the same success. Investment banking offered something traditional banking couldn't: much bigger profits. But those profits came with much bigger risks. Instead of simply protecting clients' money, banks were now trading complex financial products. They were financing hedge funds and making aggressive bets in global markets. As long as markets kept rising, everyone looked like a genius. Inside Credit Suisse, confidence was growing. Year after year, executives believed they had found the perfect balance between growth and risk. But the faster the bank expanded, the more difficult it became to control everything happening inside it. Then came the first warning signs. During the late 2000s and 2010s, Credit Suisse became involved in a series of costly scandals. Some involved failures to prevent money laundering. Others involved helping wealthy clients hide assets from tax authorities. Each case damaged the bank's reputation. Each investigation cost millions. Each settlement made headlines around the world. Yet the business kept growing. Profits continued. Executives promised investors that every problem was under control. From the outside, Credit Suisse still looked like one of the safest banks. But inside, the list of problems was getting longer every year. Then, in 2019, something happened that shocked even the banking industry. Credit Suisse admitted that it had hired private investigators to secretly follow one of its former senior executives after he left the company. The story quickly became international news. People expected corporate competition, but spying? That was something else entirely. The scandal raised serious questions about the culture inside the bank. If senior leaders were willing to approve something like this, what else was happening behind closed boardroom doors? The bank apologized, and an internal investigation followed. But once again, Credit Suisse managed to survive. At least that's what everyone believed. No one knew that much bigger problems were already waiting just around the corner. By 2020, Credit Suisse had already survived years of scandals. But the biggest threat wasn't coming from criminals, regulators. It was coming from two companies the bank trusted. One was called Greensill Capital. The other was Archegos Capital Management. First, they looked like valuable business partners. They generated large fees. They attracted wealthy clients. And they helped Credit Suisse compete with the biggest investment banks in the world. But behind the impressive numbers, both companies were far riskier than they appeared. And Credit Suisse was about to learn that lesson the hard way. Let's start with Greensill Capital. Founded in 2011, Greensill presented itself as a financial technology company that made it easier for businesses to get paid. Its business grew incredibly fast. Investors loved the story. Credit Suisse also saw an opportunity. The bank created several investment funds linked to Greensill's business. These funds allowed Credit Suisse clients to invest billions of dollars. For a while, everything appeared to be working. The funds produced steady returns. Clients were happy. Executives believed they had found another profitable business. But there was one serious problem. Much of Greensill's business depended on a small number of customers. If those customers stopped paying, the entire system could begin to collapse. That risk was far greater than many investors realized. Then, in early 2021, everything changed. Greensill Capital suddenly lost the insurance that supported much of its business. Without that protection, confidence disappeared almost immediately. Within days, the company filed for insolvency. For Credit Suisse, the consequences were enormous. The bank had to freeze investment funds worth around $10 billion that were linked to Greensill. Thousands of investors suddenly couldn't access their money. Many believed their investments were safe. Now they faced uncertainty. The bank promised to recover as much money as possible, but the damage had already been done. Many people began asking a difficult question: had Credit Suisse properly understood the risks it was asking its clients to take? And before the bank could recover from Greensill, an even bigger disaster was already unfolding. While Credit Suisse was still dealing with the Greensill crisis, another disaster was quietly growing behind the scenes. This time, it involved a little-known American investment firm called Archegos Capital Management. Unlike traditional hedge funds, Archegos managed the personal wealth of its founder, Bill Huang. To most people, Archegos wasn't a household name. But on Wall Street, it controlled enormous positions in several major companies. How? By borrowing huge amounts of money from some of the world's biggest banks. Credit Suisse was one of them. The bank believed Archegos was a valuable client. It generated millions of dollars in fees. The relationship seemed profitable, but there was one problem. Credit Suisse allowed Archegos to borrow extraordinary amounts of money while taking on far more risk. Some risk managers raised concerns. But the business continued. The profits were simply too attractive to ignore. In March 2021, the market suddenly turned against Archegos. Several of its largest investments began losing value. Normally, when this happens, banks ask clients to provide more cash as protection. This is called a margin call. Archegos couldn't meet those demands. Now, every bank faced the same question: should they wait or sell the investments immediately? Some banks acted quickly. They sold billions of dollars worth of shares before prices fell further. Credit Suisse didn't move fast enough. By the time it began selling, stock prices had already collapsed. The losses were devastating. When everything was finally counted, Credit Suisse had lost approximately $5.5 billion. It was one of the biggest trading losses in the bank's entire history. The financial loss was enormous, but the damage to the bank's reputation was even worse. People wanted answers. How could one client cause billions of dollars in losses? Why hadn't the risks been controlled? What had gone wrong inside the boardroom? Credit Suisse launched an internal investigation. The report found serious failures in risk management. It described a culture where warnings were ignored, controls were weak, and important decisions failed to stop dangerous levels of risk. Several senior executives left the bank. But replacing people couldn't restore something much harder to rebuild: trust. The Archegos disaster should have been a turning point. Credit Suisse had lost $5.5 billion. Senior executives had resigned. The bank promised investors that it had learned its lesson. New leadership promised stronger controls, better risk management, a fresh start. But rebuilding trust is much harder than replacing executives. Investors were no longer asking, "Can Credit Suisse make money?" They were asking something much more dangerous. Can Credit Suisse be trusted? Over the next 2 years, that question became harder and harder to answer. The bank continued trying to recover. It raised new capital, reduced risky businesses, promised major reforms. But problems kept appearing. Investigations, legal settlements, questions from investors. Negative headlines became almost routine. Each story by itself might not have destroyed the bank, but together, they slowly weakened public confidence. Banking is different from most businesses. A car company can survive bad headlines. A retail company can survive a difficult year. But a bank depends on one thing above everything else: trust. If people stop believing their money is safe, they don't wait, they leave. Then came 2022. Around the world, central banks began raising interest rates to fight inflation. Financial markets became more unstable. Investors grew more cautious. Banks everywhere faced increasing pressure. Credit Suisse entered this difficult period carrying years of damaged credibility. Its financial results disappointed investors. Its share price continued falling. Customers started moving billions of dollars to other banks. Executives insisted the bank remained financially strong, but confidence doesn't disappear all at once. It fades, little by little, until one day, a single event is enough to trigger panic. And that moment was now getting dangerously close. Then came March 2023. The global banking industry was already on edge. Just days earlier, Silicon Valley Bank had collapsed in the United States. Investors everywhere became nervous. People started asking a simple question: which bank could be next? Credit Suisse was already under pressure. Years of scandals, billions in losses, falling profits, and declining customer confidence. Now the market was watching every move the bank made. The smallest mistake could trigger a much bigger crisis. On March 15, 2023, Credit Suisse's largest shareholder, Saudi National Bank, was asked a simple question during a television interview. Would it invest more money into Credit Suisse? The answer was short: no. The reason was mainly regulatory. But the market didn't focus on that explanation. It focused on one word: no. Within minutes, Credit Suisse's share price plunged. Investors panicked. Confidence, which had already been weak, started disappearing even faster. For a bank, it is one of the most dangerous moments imaginable. Customers began withdrawing billions of dollars. Investors rushed to sell shares. The Swiss National Bank announced emergency financial support to help stabilize Credit Suisse. For a brief moment, it looked like the crisis might be under control. But confidence had already been badly damaged. Swiss regulators knew they couldn't take the risk of waiting. If Credit Suisse failed, the consequences could spread far beyond Switzerland. Officials spent the entire weekend holding emergency meetings with executives from Credit Suisse, UBS, the Swiss National Bank, and the Swiss financial regulator. Their goal was simple: prevent a global banking crisis. By Sunday evening, a decision had been made. One of Switzerland's most famous banks would no longer exist as an independent company. On March 19, 2023, after days of intense negotiations, the decision became official. UBS would acquire Credit Suisse. The deal was worth approximately 3 billion Swiss francs in UBS shares. Just 2 years earlier, Credit Suisse had been worth many times that amount. For a bank that had helped shape modern Switzerland, it was a dramatic ending. But the story didn't stop there. To make the takeover possible, Swiss authorities introduced emergency measures. One of the most controversial decisions involved a special type of bank bond known as a T1 bonds, or additional Tier 1 bonds. These bonds were designed to absorb losses during a financial crisis. Swiss regulators decided they would be written down to zero. Around 16 billion Swiss francs worth of AT1 bonds became worthless overnight. The decision shocked financial markets around the world. The takeover marked the end of one of the world's oldest and most respected banks. Founded in 1856, Credit Suisse had survived world wars, economic crises, political uncertainty, and countless market crashes. But it couldn't survive a crisis of confidence. Over the years, one scandal became another. One risky decision led to the next. Each mistake weakened the bank's reputation, until finally, customers no longer believed their money was safest there. In banking, that is often the point of no return. Investigations continued after the takeover. Regulators reviewed what had happened. Analysts examined years of management decisions. One conclusion appeared again and again. The collapse wasn't caused by one bad investment. It wasn't caused by one CEO. And it wasn't caused by 1 week in March 2023. It was the result of years of poor risk management, repeated governance failures, and a gradual loss of trust. The emergency takeover prevented a larger financial crisis. But it also marked the end of an institution that had stood for nearly 167 years. The name Credit Suisse would disappear, but the lessons from its collapse would not. When people think about Credit Suisse, they often ask, what was the biggest mistake? But that's the wrong question. There wasn't one mistake. There wasn't one disastrous meeting. There wasn't one executive who caused everything. The collapse was the result of many decisions made over many years. One scandal damaged trust. Another exposed weak controls. One risky client created huge losses. Another crisis pushed confidence even lower. Each problem seemed manageable on its own. Together, they became impossible to overcome. That is how many great companies fail. Not all at once, but one decision at a time. Credit Suisse also reminded the world of something many people had forgotten. A bank doesn't sell phones, or cars, or software. A bank sells trust. When you deposit your money, you're trusting that it will still be there tomorrow. If enough people lose that trust, even a bank with billions of dollars can find itself fighting for survival. That's exactly what happened in March 2023. The financial system didn't collapse because Credit Suisse ran out of buildings, or employees, or customers. Collapsed because confidence disappeared. And once confidence is gone, it's incredibly difficult to bring it back. Today, the Credit Suisse name is slowly disappearing as its business is integrated into UBS. But its story remains one of the most important corporate lessons of the modern era. It showed that reputation takes decades to build, but only a few years to destroy. It showed that ignoring small warning signs can create much bigger problems later. And above all, it proved that the most valuable asset any company owns isn't its headquarters, its technology, or even its money. It's trust. Once that's gone, everything else becomes much harder to save.